Welcome to our today's feature presentation, Trading and Investing Behavior. In 30 minutes, we want to lay out the ground rules and all steps of the way needed to turn yourself into the trader and investor that you want to be. My name is Thomas Barman. I'm your presenter today, and I want to make you aware of the risk in trading and that I'm not here as a broker, dealer, or financial advisor. I'm here as an educator. Every stream of income we generate requires a certain behavior. And what we did in here is painting the different streams of income, and then we want to relate the behavior and what is required to be successful. So HJ, when you have a job, so you work for somebody else, and you are in the structure, things are organized, you work for a certain period of time and you get paid. If you are an OJ, you're not an orange juice, no, you own a job, so you are a lawyer or you are a doctor. And with that, you basically drive your income from your personal knowledge and from your skill, and you have very little personal working for you. That changes when you're a business owner. Yeah, usually here you have multiple people work for you, running a business where you work in yourself or you have somebody else running it, but you derive your income from what's accomplished through others in your business. Now we are coming to the AI. You are an investor, and in the investor, we'll come to that, you get returns from investments that you make. And there's a certain behavior difference, and I want to draft that out for you. In 3 out of the 4 quadrants that we laid out here, we have a behavior that tells you work hard, get the job done, be active, be action-oriented and dedicated, and it pays off. Yeah, HJ, BO, and OJ. AI is a difference. When you are an investor, only smart investment gets you the desired return. Thus, you don't invest because it's Monday or because you feel it's important. You invest when certain conditions of your investments promise you a high probability for return. So that's different. So you're not action oriented, driving, investing your money because you feel it's good to make those turns. You are doing it when specific conditions are met. And I'll go through the conditions that need to be met for a trader and investor to be successful. Trading and investing success needs certain systematics. A system that gives you the rules of what you do. However, that's not good enough. You also need to work on yourself within getting the right attitude and the right behavior established for turning yourself into the trader or investor that you want to be. And we go through the steps of the way with you. Starting with the systematics. You need a system that gives you clear-cut conditions: when to enter, when to exit, and where to place a stop or price adjustment level for every trade or investment you'll do. If you don't have that, if you leave it up to interpretation, I'll show you down the way what it can cost you, most likely will not establish trading or investing success. To get you to be the trader or investor that you want to be, you need to have skills like leveraging or hedging. So what do we mean like that? When the situation is very favorable, how can you leverage without increasing your risk? This is a skill base you need to have. Or on the other way, if you're fully invested like in an IRA, what will happen if the market turns overnight? Do you have a hedge in place that turns around with your portfolio when the market moves from an upside move to a downside move? Those are skills needed to have been down in your portfolio of skills to help you to turn yourself into the trader or investor that you want to be, and we go into more details. The next skill to add is asset knowledge. Yeah, trend finder. How do you know where prices move? Is your system producing those price moves for you? Is it giving you the conditions under which you enter? And the mechanics, how you place your orders, like for example an OCO order under certain condition that goes in with a buy stop when the price of an asset moves to a certain price level, or a sell stop, and then the order goes in automatically without the need for you to be in front of your computer. All of those are real hard requirements to have at your fingertips if you want to be successful in trading and investing. But it's not enough to have the systematics right. There is a lot more to be done. With that, we are coming to attitude. Attitude in the way of what risk management do you have in place? What's the maximum risk you allow per trade? How do you odds-based adjust your position size and your money management so that you prevent drawdowns, but on the other hand, also participate to the upside? All of that needs to be in place, and you need to have these rules to be successful, because the pro trading world operates like that, and we want you to do the same just at your personal level. And with that, also having a business plan, a written plan in place that tells you how do you prepare for your trades, under which circumstances are you putting money into the market, and how often do you want to do your trades or investments, what return do you expect, what's the maximum risk you agree to, and all of that has to tie into each other, bringing you forward to be par to par with the pros. If you're a part-time or full-time trader or investor, discipline comes into place. You need to be prepared for what you want to do. You need to be focused. And it really doesn't matter if you do that part-time or full-time. All these individual steps of the way you need to somewhere accomplish to be successful against the pros in the market who are ready to take your money. But not enough, we come to behavior on that side. Yeah, with behavior, analytical. Very important. You need to be prepared, analytical, understand the market situation, understand the assets that you are trading, and the price move, the underlying conditions under which they operate. And that's a very integral part where you saw in the other parts of the quadrant, you be more action oriented, getting things done after you analyzed. But here you analyze day by day, knowing what to do. And instead of being action oriented, you handle under certain conditions. Your conditions need to be met, and also you need to handle your emotions, because all of us run between fear and greed somewhere in investing, and we only want to take condition 2 orders and bring them to the market. And when we have it all in place, we want to be repetitive on it with the systematics, with the attitude, with the behavior and the fear and emotional handling, and be repetitive, repeating what works, and also not repeating what does not work. And we will come in a short while to the mistakes that are made and how to prevent them. Let us assume you had a high probability trading system in place. High probability for us starts if you have a 65% chance to predict the future outcome of a price move correctly. Everything below, and that's where most of the traders operate usually, we don't call high probability, and with that has a much higher risk for giving you the returns that you want. But if you had such system in place, what would be the statistics or the expectations? Yeah, to do that, we'll do the Bernoulli experiment, and we are looking at 20 trades. Yeah, so it could be 20 trades in a months, in a couple of days, or in a year. It doesn't matter. So we take 20 trades with 65% probability and draft the outcome and the probability that you make more money that you lose. Yeah. So here it's pretty easy, because you see you make more money if you win more than 10 trades out of this, as long as you don't risk more than your return is. Yeah. So, and that's, it looks like, okay, when we follow through with that curve, that looks like a high probability that we get there. But can we specify it? Absolutely. You have an 87.8% chance to make more money with a 65% trading system if you follow the rules. That's substantial, isn't it? However, when we look into the details here, 87 and 12%, on the other hand, you have a 42% chance to make substantially more money, because if you win more than 13 trades, that's where the balance is here, then out of 20, then you substantially make more money. But now the question is that what is happening? We at times do a marble experiment with our students. We put 20 marbles in a bag, 13 winning marbles and 7 losing marbles. So we have a 65% likelihood, and they have to bet on the outcome of a draw, and then we put that marble back into the bag. And so the draw always has a 65% probability. What you see here in red is the outcome of this. And so you see, it looks substantially different. Why? Yeah, because unfortunately, after 20 games or 20 trades, 60% of the people participating come out with less money than they started out with, and only 40% make more. So a substantial difference between what we saw before, 88% probability statistically to make money, and here only 40%, less than half of the people come out making more. And we'll ask ourselves why that happens, and we quantify it for you and show you every step of the way to prevent that such a thing is happening to you, even though you operate with a 65% probability. While again, most people don't. They have a low probability system, and then the disaster is already painted here on the wall. So let us spell out and quantify the typical trading mistakes that happen that bring that imbalance of a statistically high likelihood to make money to a reality that it's not happening. The first mental trap many traders and investors get into is the assumption that they can constantly operate at situations where they can attain a higher reward than the risk they take. What we did here is we drafted those situations and how often those setups occur. And you see it's only 5 to 10% that you trade for a higher reward than the risk you take. Then here you find an area of balance. And also you get an area where there's many trades where the reward is lower than the risk. And you'll need to make a decision of what you want. Yeah, so magnifying into the situation, we have here that bar where your risk is higher than 1.2 times the reward, and your system needs to tell you when that is happening because this you don't want. Period. So 35% of the trade setups shall not lead for you to an investment or a trade because the situation from the get-go is unfavorable. And your system needs to tell you that because that can be very, very, very costly. On the other hand, the others are rare, and I show you on a statistic in the draft of why. So you only have about a 10% or 5% chance to get the others. But what you need to put in your mind is when that is all true, then the reality is that risk and reward is about in balance, and that's clear because there is no risk-free trade. And on those situations, you need to operate with a high probability system, giving you more opportunities to make money than you to lose money. And that's important. Yeah, carving out the bad trades, focusing on the good trades, and running the statistics as a probability thinker. Let us jointly look at an example. This is a Neverlos trading chart. It shows Google on a daily chart, year to date, basically, when the video is recorded, so for 3 months. And you see there's plenty of opportunities where high probability trade setups are spelled out, and I want to look at 3 here that have a higher likelihood to make a further price move. Yeah, so the first one up here, the orange, it was confirmed and it made a higher price move. Yeah, the second was here, which was confirmed, and here we have one that did not get confirmed. So overall, we had basically 15 other opportunities and 2 opportunities where the reward to risk was higher than 2 to 1. Yeah, and I want to show you this. If you can participate in all those opportunities along the way of a price move, you have a much higher likelihood to harvest. If you constantly look at those and they don't happen, you get stopped. And we have certain conditions, and that's what you want to have as a trader, conditions under which you operate, and focusing on one-on-one or sometimes better price moves and carving out the ones where the reward and the risk are out of balance. And we take that at a statistic when the risk is 1.2 times higher than the reward, then we don't want to trade. Turning you into a probability thinker, in a quick summary, so risk reward setups 2 to 1 or higher are rare to find, 5 to 10%. 35% of the opportunities are too risky, you don't want them, and your system need to tell you when not to trade. And for the rest, you somewhere need to operate between one-on-one risk to reward, but you need a high probability trading system to put that in place. High probability, 65% or up. Out of 20 trades, 13 winners consecutively by the same rules. So that's what you want to achieve. You saw in the prior statistics that even when people were operating on a 65% likelihood to succeed, they still didn't make the money that they deserved. So we want to quantify the mistakes together here and put together a little model where we look at 20 trades, 20 trade situation in an observed time unit, and we look at an expectancy of one-on-one risk reward, and we just say when we do so, we risk $1,000 to make $1,000, yeah, regardless of what that means in relation to our account. That's what we just take for the model. If we do so, and we then draft the typical mistakes and quantify them, this is how they look like. The first costly mistake people get into is trading without a stop or adjustment level, under the assumption, hold on, it's going to get better, and we know that outcome. It usually doesn't get better. And quantifying this, usually a trader gives 3 times the risk tolerance to a thing where they entered without a stop. And that's not good, because then you're overstating the risk, and the outcome will be detrimental at the end of the day. The other side to that is exit on emotion. Oh, I felt like the trade is turning on me, so therefore I cut my profits short and I took them early. Also a costly mistake, and I will show you in a model of how that can be equated. Yeah, too tight stop. Yeah, I give very little risk tolerance, but inside the statistical volatility, what will happen? You will get stopped, and then the price commences into the direction that you desired, and you're stopped and you miss out on the opportunity. Yeah, or you have an emotional entry. Yeah, so somebody gave you a great stock tip, not your system. With that, you put your money behind, and it's not working out, but you give a little more risk tolerance because the cognitive dissonances in us, we are looking for approval for what we decided for, and then we hold that trade a little longer than we anticipate. And all of that can be quantified, and all of that can be prevented. So if you operated with a 65% predictability on 20 trades with a one-on-one risk reward, risking 1,000 to making 1,000, and you win 65% of the time, you have 13 winners, 7 losers. So the balance of that would be a $6,000 profit. But often that doesn't happen because we quantify now the mistakes together, and look what they do. No stop, you give 3 times the adjustment level and you get caught. $3,000, so 50% of your attainment that you were striving for are gone by the first mistake. You might at this point say, wait a moment, that's not happening to me. However, let me give you a little example. If you have the right system in place that tells you to turn on a situation, then surely not. But do you have such? Here, GE. What we see is monthly bars on GE, and in May of 2017, our system told us go short GE and repeated that message over all along to where we are today. But trust me, many who were in at 30 are still in at 14. That's a 50% cut. And that's what we try to prevent, and that's what we try to teach you here. At the same point and the same token, had you known to get out of GE, you could have made that swap and get into Facebook, because the system told here clearly buy, 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 and the latest buy was all the way up here, December. Say, okay, buy, but get out here right at the high. And this is what the system was predicting. Here at entry, you knew a little off the high, there is my target, and then I take profits in Facebook. And you could have turned from one investment vehicle into another, have you operated with a high probability system. If we now add the early entry, so at about 20% of the trades, 4 trades, you cut your profits short for giving $2,000 of income by doing so, because you felt the trade might turn against you, emotional exit, that costs you, because you see with those 2 actions, basically you're already balancing out the entire profit that you were supposed to make, but it's getting worse. If you work and operate with a too tight stop, we quantified that here, so made the example, so you operate with a $200 stop instead of the 1,000 that is needed to bring the price to target, then you surely prevent 1 time the higher loss, but on 3 times you are making less income because you're getting stopped. So balancing all of that out, we quantify this mistake here with $2,800. And when you add them up, you already see we're negative, but then it comes the stock tip, the emotional entry, something that you needed to do because the media or somebody else told you that's a good investment. It turns on you and then gives you another $4,000 of risk. All of that together is more than balancing out your expected income, and this is why often people, even when they operate with a high probability system, turn a winning system into a loser by getting into all of those mistakes. Striking the balance, what had started with a very positive expectation of $6,000 now turns out to making kind of like a $6,000 loss. And that's a disaster. And we try to help you and help traders to not getting into those traps by following clear-cut rules. Yeah, clear definition of a stop or a trailing stop. That is essential. That is very, very essential. And at entry, define your exit so that you can operate with an OCO or a bracket order. Yeah, so the chart needs to tell when to buy or sell, where to enter, where to exit, where to stop. All of that needs to be in place for you that you can follow clear-cut rules and measure the statistical volatility so that you have dynamically an appraisal of the situation. And when the risk to take for the trade, because so much volatility is required for you to give, is higher than 1.2 times your reward, what do? You're not going to trade. But only with those rules in place, you will be able to also hold to the price exit that is defined at entry and follow the rules, preventing all those detrimental mistakes that I just had listed. Let me give you some examples. What you see here is the chart for Apple on a daily chart, and we'll magnify into the situation. You see here highlighted situations were confirmed. How do we confirm? So by the rules, the price move of the next candle has to take out the price threshold. So that means 173.20, you can operate with a sell stop order, and here the next candle definitely took out that price threshold, and with that you would enter with the sell stop order going short in Apple. When you say, wow, I can't go short, I have an IRA, then we would show you an option strategy that is allowed in the IRA to follow that. And you see here, these red lines would be trailing lines, and you see multiple entries along the way to the downside and to the upside, and we appraised these situations here. There was a loss in it too. I just didn't highlight that segment because it was too big. It would have taken out all the information here. But you see here multiple winners, but also a loser all the way with the price move of Apple. And just recently we had a buy above 180, was confirmed, and right here at the high we were able to take that profit because the system told us to exit right at the dot, which was a little bit a tip below that wick of the candle up here. In this chart here, you see the ES, the S&P E-mini futures contract, and I drafted two examples between 3.5 and 3.11, yeah, so March of this year. And you see on both situations, we were trading about for 40 points. Yeah. And in these situations, we had the opportunity of only risking about 20. Yeah. And so we spell out the price threshold, which has to be surpassed in the next candle that happened here. And we'll spell out the targets and also the time to target. So here to the target 2, we need about 1 to 10 bars, to the target 1 to 5 bars to accomplish that price move that's here on the chart. And you see in both instances it happened, and it happened on a substantial income with a meaningful risk, all spelled out at the situation. And you see here with these trailing lines, you can follow through and trail your stop if you desire, while most of the time we'll keep our stop right at bay. But with all of this at place, you know your entry condition, you know your exit condition, you know your stop condition, and you know your time in the trade. That is needed for all of you here in our systems that we show. That is always a given, so that you know that after a certain period of time, if the trade didn't get to target, you'll close the trade because the market or the price pressure might not be behind it to bring it where you assumed that it's going to go. When you operate under such conditions with clear-cut rules, you have a high likelihood with a high probability system to come out being a positive trader or investor. Throwing in another example, this is the euro dollar, and you see again at two trade situations, the others weren't confirmed, so therefore they're not highlighted. Just recently here, that was go short, and you saw here first goal was 30 pips, get out, yeah, at 30 pips, or here you got a continuation signal on the way on the trend, giving you an idea that you can add another 45 pips. But again, rule-based trading, clear-cut entry, clear-cut exit, defined price move to target, and when the risk and reward is in a certain balance, you accept the trade, else you do not. This is how you can constantly decide and find trades based on the assets that you like to trade and based on the portfolio of assets that you want to hold as a trader or investor. We hope you now see that multiple individual changes in the behavior and in the systematics are needed to be a successful trader. With that, we help our traders giving clear-cut rules, giving clear-cut balances between risk-reward, having strategies in place to trade different situations, and following a clear-cut plan which gives you under which circumstances you trade, how many trades you expect per time frame, how you filter out the high probability setups, and doing that repetitively. We teach all of this one-on-one. Only by the one-on-one teaching we can focus on you as the trader and investor you are and what you want to achieve, and then focus our systems and everything around you to help you, to guide you, and to bring you to the attitude and behavior change for being long-term in the trading business and for striving for success. And to do so, we help you and install the software for you. You have nothing to do with that. It paints real time the data on your chart to help you defining those trading positions and those trading situations, giving you clear-cut entries, exits, and stops, help you with the position sizing. So we use a lot of models that help you depending on the odds of the situation that you enter, how much you put, half a lot, full lot, 3 lot, 4 lot. We'll see all of that with the risk agreements that we work with you, specifying the time in the trade. You saw that for a certain signal we are 1 to 5 or 1 to 10 bars, others 1 to 3 bars in the trade. We do the risk handling to not have the big drawdowns that can happen because no system works at 100%, and putting all of that together in a written business plan for trading success where you can follow clear steps from where we hand over to you, but also we have always a period where we coach with you, giving you feedback to help you to turn yourself into the trader that you want to be. There are many elements needed to tie together to turn yourself into the trader and investor that you want to be. And we support you in one-on-one training. And if you want to see how the system works, what we can do for you, call us at 866-455-4520 or contact at neverlosttrading.com, and we'll work with you and see what we can do for you and how we can help you to turn yourself into the trader and investor that you want to be.